What if I told you that the money in your wallet is not the same money your parents used, even though it looks the same, sounds the same, and carries the same numbers? What if I told you that without a public vote, without protests, without dramatic headlines, the very meaning of money was quietly rewritten right in front of us? No collapse, no invasion, no announcement declaring a revolution. Just a slow, almost invisible transformation carried out by central banks while the world was distracted by wars, pandemics, elections, and market chaos. Here is the mystery that almost no one asks. When did money stop being something you own and start becoming something you're merely allowed to use? And how did this happen while everyone was watching, yet almost no one noticed? Welcome to its financial history too. To understand the change, we have to go back to how money originally worked. For most of human history, money was physical and final. Gold, silver, coins, things that existed independently of governments. If you had money, you truly possessed it. You could hide it, trade it, or bury it. No permission required. Even when paper money appeared, it wasn't real money by itself, it was a receipt. A promise that somewhere, in a vault, there was real value backing it. This system created natural limits. Governments couldn't endlessly print money. Central banks couldn't expand supply without consequences. Every new unit required something real behind it. Limits, however, become a problem during crises. Wars are expensive. Economic collapses demand intervention. And political survival often requires spending that reality cannot support. The first quiet rewrite of money happened during emergencies. World War I forced governments to suspend gold convertibility to fund massive military operations. After the war, many promised to return to the old system, but the discipline of real money had already been weakened. Then came the Great Depression. Banks collapsed, credit vanished, unemployment soared, deflation crushed economies. In response, governments chose control over constraint. In 1933, the United States made private ownership of gold illegal. Citizens were forced to turn it in. The dollar was devalued. This was described as a temporary emergency measure. It never truly ended. From that point on, money was no longer just a store of value, it became a policy tool. After World War II, the world attempted to restore stability through the Bretton Woods system. The US dollar was tied to gold, and other currencies were tied to the dollar. On the surface, it looked like discipline had returned. In reality, it was an illusion built on trust. The United States began running massive deficits. Wars, social programs, global military commitments, all funded by dollars sent across the world. Those dollars were theoretically convertible into gold, but there was far more paper than metal. Foreign governments noticed. They started asking for gold instead of promises. By the late 1960s, the system was cracking under its own weight. And then, quietly in 1971, the final link between money and reality was cut. The United States suspended gold convertibility. Overnight, global money became purely fiat backed by nothing except confidence. There were no riots, no mass outrage, markets reopened, life continued. Most people didn't realize anything fundamental had changed, but everything had. From that moment forward, money had no natural limit. At first, central banks used this power cautiously. Inflation in the 1970s reminded them that excess had consequences. Interest rates were raised. Discipline returned briefly. But over time, every crisis pushed policy in the same direction. Easier money, lower rates, more intervention. Each solution created a new dependency. Then came 2008. The global financial system came dangerously close to collapse. Banks failed. Credit froze. Markets panicked. Central banks responded with tools that had never been used at this scale. Trillions of dollars were created digitally through quantitative easing. Not printed, but typed into existence. Used to buy financial assets, stabilize banks, and restore confidence. This time the rewrite went even deeper. Money was no longer just a medium of exchange. It became a mechanism to support asset prices, protect institutions, and prevent systemic failure. Emergency measures became standard practice. Temporary tools became permanent features. Most people still didn't notice. What they did notice came later. Housing prices exploded. Stocks surged. Wealth concentrated. Wages lagged behind. Saving became harder. Debt became normal. Money was no longer neutral. It rewarded those closest to financial markets and punished those who relied on wages. Central banks had quietly become the most powerful economic actors on Earth, setting interest rates, shaping incentives, and deciding who survived crises. Then inflation returned. Not the wage-driven inflation of the past, but inflation born from years of expansion, colliding with supply shocks. Central banks reversed course. Rates rose rapidly. Markets shook. Governments struggled under the weight of debt that only worked in a low-rate world. Now the system faces a dilemma with no clean solution. Tighten too much, and economies fracture. Ease too much, and currencies weaken. Every fix creates a new vulnerability. And while this struggle plays out, another quiet rewrite is already underway. Digital money. Central bank digital currencies. Programmable systems where money can be tracked, limited, or directed in real time. This is presented as progress, efficiency, inclusion, safety, but history shows a pattern that repeats with unsettling precision. Crisis creates urgency. Urgency justifies change. Change becomes permanent. Each rewrite reduces friction, each one increases control. And each one is introduced gradually enough that resistance never fully forms. This is not about conspiracy. It's about incentives. Central banks respond to instability by expanding authority. Governments respond to pressure by accepting it. And the public adapts because adaptation feels easier than resistance. The most important lesson is this: money is no longer just something you use, it is something used on you. To encourage spending, to discourage saving, to stabilize markets, to manage behavior. Second, every crisis accelerates centralization. Fear shortens attention spans and lowers resistance. What would be unacceptable in calm times becomes necessary in emergencies. Third, once control shifts upward, it almost never flows back down voluntarily. The question is not whether money will change again. It will. The real question is who decides how and who bears the cost when it does. Because the most powerful changes in history are not announced loudly. They happen quietly, while everyone is watching something else. If this story changed the way you think about money, share it with someone who believes currencies are permanent and neutral. And if you want more deep, uncomfortable truths about finance, power, and the systems shaping our future, subscribe. Understanding history is the only defense against being surprised by it again.